Welcome to the CFO Suite Investment Academy. Most investors fail because they lack a system. Today, we're changing that by mastering the strategies used by the world's top institutions. We will break down 4 distinct pillars: value, growth, momentum, and contrarian investing. By the end of this lesson, you'll have an institutional-level toolkit. Let's start with the foundation of modern finance: value investing. This is the strategy famously championed by Benjamin Graham and Warren Buffett. The core idea is simple: buying an asset for less than its intrinsic value. It's like buying a dollar for 70 cents. But how do we find that value? Institutions look at hard data: low price-to-earnings ratios, price-to-book values, and strong dividend yields. These metrics suggest a company is undervalued by the market. Take a classic example like Coca-Cola. It's not flashy, but its consistent cash flow and market dominance make it a value staple during market downturns. Next, we have growth investing. While value looks for bargains, growth investors look for companies expanding at an above-average rate. These companies often reinvest all profits into research and development. They aren't cheap by traditional metrics, but their future potential is massive. The risk? You're paying a premium. If the company misses a growth target, the stock price can plummet. This is high reward, but high conviction investing. Think of NVIDIA. Investors aren't buying it for today's earnings, but for its total dominance in the AI revolution of the next decade. Now let's talk about momentum. This strategy ignores value and growth fundamentals and focuses entirely on price trends. In finance, physics applies. An asset in motion tends to stay in motion. Momentum traders buy what's already going up, expecting the trend to continue. They use technical indicators like the RSI or moving average crossovers to time their entries and exits. It's fast-paced and requires strict discipline. The danger is the momentum crash. When the trend breaks, it breaks hard. Successful momentum traders use tight stop losses to protect their capital. Finally, we have the contrarian approach. As the name suggests, this involves buying when everyone else is selling and selling when everyone is greedy. It's psychologically difficult. It requires going against the headlines and the crowd. But this is where the most significant institutional wealth is often made. Sir John Templeton famously said that the time of maximum pessimism is the best time to buy. Contrarians look for systemic fear to find long-term entry points. Look at the 2008 financial crisis. While the world panicked, institutional contrarians were buying high-quality assets at generational lows. The most successful investors don't just pick one. They build a multi-strategy portfolio to balance risk and capture different market phases. A balanced allocation might include a core of value for stability, growth for upside, and a small portion for momentum or contrarian tactical plays. Regardless of the strategy, the golden rule is risk management. Position sizing and knowing your exit before you enter is what separates pros from amateurs. Remember, the goal isn't just to be right, it's to stay in the game long enough for compounding to do the heavy lifting. Time is your greatest asset. Here is your immediate takeaway. First, define your time horizon. Second, choose a primary strategy that fits your personality. Third, automate your risk limits. At the CFO Suite, we provide the institutional-grade data and intelligence you need to execute these strategies with professional precision. This lesson is powered by the CFO Suite. For more institutional-grade financial education, visit thecfosuite.ai. Strategy is the map, but discipline is the vehicle. Remember, the CFO Suite is not a licensed stockbroker or financial advisor. This content is for informational and educational purposes only. Always consult a qualified financial advisor before making investment decisions. Master your strategy and master your future.